This video is brought to you by the Minnesota Department of Human Services, titled Long-Term Care Financing, What's New? This webinar was recorded on December 7th, 2018.
Good morning. Thank you for being here today to talk about the current status and future of long-term care financing in Minnesota. And as our state continues to navigate the age wave, I think discussions like this are critical to ensuring older adults receive the best care possible in a fiscally responsible manner. They're also a way to help forge really essential partnerships that we need to carry out this work. We have around 150 people, both public and private employees and other partners registered for today's event. Many are joining us online, so I'd like to welcome those of you who've tuned in Minnesota and across the country. Before we start the What's New portion of today's forum, I think it's important to begin with some background about how we arrived here today. The Own Your Future initiative grew out of concern when national demographics showed that the number of older adults was expected to double between 2010 and 2030, and life expectancies at the same time would continue to escalate as well, which is, obviously good news. And this was especially true in Minnesota, as we have the second highest life expectancy in the United States, just second to Hawaii. And in a joint effort, federal and state governments agreed that they needed to get a message out to people all across the country that they had to plan for a much longer life than they originally anticipated, and I think in the past had been true. And so 27 states co-sponsored Own Your Future initiatives with the federal government. And it essentially consisted of a public awareness campaign, public service announcements by state governors, and other forms of public outreach. And most of the states concluded their initiatives within about 3 to 6 months of the initiative starting. And in Minnesota, of course, we're special and different. And so we felt that it was very important for us to continue to do this important work and really take it a step further to try and redesign and foster an environment to redesign a phase of the work that included some development of affordable products, because of course the conversation is one thing, but when people can't afford whatever is available, I think it kind of falls flat that people should continue to plan for their future. And really bringing more private money into the long-term care financing system became one of our guiding principles as we moved forward. By finding new approaches to help middle-income Minnesotans use private insurance or financial services products, we could reduce, not only better help foster an environment where people were empowered, but also use private funds to decrease the demand for public funding of long-term care in the state of Minnesota. And really, the goal, I think, overall is to delay the need to access Medicaid or other private or other public resources, and ultimately, I think in some situations, avoid the need for it entirely. And so we embarked on this Own Your Future journey, and today you'll hear more about the various steps that we've taken along the way as we've explored new and really refreshed options on how to pay for long-term care. So with that, we have a lot of ground to cover today, and if you check your agenda, you'll see that we've gathered both new friends and old friends to help us tell the story of long-term care financing here and in the future. And there'll also be some time after our keynote speaker and at the end of the forum for questions and comments from the audience. To start, I'd like to introduce a person who really, I think in this group probably needs no introduction, Lorraine Canadaru, Director of Aging Transformation in DHS's Continuing Care for Older Adults Administration. And Lorraine will provide a quick rundown of the work that's been completed by Own Your Future. And Lorraine, as most of you know, has really been a leader in the Own Your Future initiative since its inception, and has also been a leader for Aging 2030, which is a project to prepare Minnesota for the permanent shift in the age of our state's population as baby boomers begin to turn 65. So please join me in welcoming Lorraine.
Thank you so much, Commissioner. And I should turn that back to thanking you for all of your support that you've given us in your tenure here at the DHS. Well, this is an incredibly wonderful moment for me because we have been working on Own Your Future for quite a few months and actually years, and now this is a chance for us who've been working on the side of research and analysis to give you, our stakeholders and our friends, information about financing in Minnesota. What I'd like to do is talk a little bit about why Own Your Future is so important, and then also tell you some of the things that we've developed and you'll hear more about as we go through the day. The first two things you need to know that you already know: we have many more older people than we've ever had before, and it's going to even be more dramatic in the future. How many of you know someone over age 95? 20 years ago, there'd probably be just a small sprinkling of hands up because we didn't have a lot of people who were over age 95. This always reminds me of my Uncle Don, a minister who lived in Fargo, and he had his 94th birthday. And we went up to Fargo to celebrate with him. And I said to him, "Uncle Don, how does it feel to be 94? And he said, "Oh, Lorraine, 94 is the new 93. He always had a great line. But hopefully we can all get to that 94 or 95. But in the past, people had not lived that long. And so we have to plan for that additional 30 years or so that comes after our retirement and the chronic conditions and some of the issues that go along with that. So that's number one. Number two of why this is important is that we're going to have some major changes in the caregivers that are available to take care of us as we age. We have now, the vast majority of services are provided by family, the informal caregivers. But we now have more caregivers than we've ever had before. And why is that? It's because the boomers are in that particular age group. And so we have a high number of people who are caring for their parents. But as we as boomers move into the last stages of our life, we're going to be looking at the Generation X, which is half the size of the boomers. And so they'll be struggling to take care of the growing numbers of older people in their families. At the same time, we have problems with shortages of formal caregivers, and we have that already. Many of you who work in aging and long-term care know that that's already an issue. So as we look at those two figures, aging and the caregiving issues, we know that we've got lots to do in terms of how to pay for and how to organize this long-term care financing. Going to the accomplishments that we've had in Own Your Future. As the Commissioner said, there were several phases that we had put together for Own Your Future. The first one was one that everyone did across the country, and that was public awareness. And I see Eileen Tell in the audience, and she was the first person that helped us kind of get into the Own Your Future mantra. And we, with the help of the federal government, sent out 1 million letters to people between ages 40 and 65, letters signed by the governor and the lieutenant governor, urging people to start thinking about long-term care planning because of what we've just described. And we got 40,000 hits on our website in about 2 weeks. And for some reason, the website took all those 40,000 hits. But very quickly, after people had kind of figured out what this was, we didn't get as many hits from people out there who got the letter. So we decided that another way to get to people is to do a consumer's guide. So since we started in 2013 with the guide, we've given away 50,000 guides to help people plan for their long-term care. And we have the new edition. I hope that you picked up a copy of that as you came in, because we're anxious to continue to get that out into the community. So take more than one if you need it and share it with your friends and neighbors, because we think that that's an important way to help people take care of their need for planning. Something else that we did is to go to the state fair, and we were happy that the Board on Aging gave us some space in their booth in the education building, and we did a survey of people who came past. You know, they're eating their cheese curds and they're on their way to the Midway. We're asking them about long-term care. But actually, people are very relaxed at the fair. They said, whatever, you know, I'll answer this. And we've even got it on an iPad now, so we're taking care of the technology. We talked to about 2,000 people each year, and we asked a variety of questions, but we always ask one that's the same every year, and that is, and if you have your, you should have this in your packet, this four-pager, and at the bottom of page 2, there's a chart that shows what the responses were to this one question. If you need long-term care due to physical and mental disabilities, how would you pay for it? And this chart shows the percent of people who said, I don't know. And if you look starting in 2012 and then 2013, we have gone from 33% of the people saying that they had no clue how they were going to pay for long-term care, down to this year, 2018, where it's 21%. Now, I'm not going to say that that was all due to our survey and what we've been doing with Own Your Future, but I can say that there are a lot of factors that have made this more personal for people now. We're all getting older. In fact, the boomers are surprised that they feel as good as they do as they grow older. But they're taking care of their parents, so they realize the need for that system and for some kind of funding. They didn't realize before that this is their own responsibility to come up with that money to pay for long-term care. So if you want measurement, this is the one chart that we have that shows there have been significant changes in the percent of people who don't know what they're going to do. This says at least people have figured out something that could help them pay for long-term care in the future. Another accomplishment has been related to the product development phase that we added to Own Your Future. We started with 15 different proposals that our advisory council helped us identify. We took 2 of those that had a lot of potential to be what we needed, which is affordable, something that middle-income people would see the possibility of including in their budget, something that was consumer-friendly, and something that had the affordability premiums. We've been working, we got additional funding from SIM here at the Department of Human Service, and that helped us do some of the actuarial work on these 2 products, as well as some consumer testing. You'll be hearing more about that from our consultants later in the day, in the morning. The other thing that we were able to do, and we wanted something that would help us not just work on these 2 products, but begin to look at other ways that people could pay for long-term care. We worked with SHADAC at the University of Minnesota to develop a projection model that would estimate and take a look at and assess the way that each of these financing options would work. Did it save Medicaid money? Did it increase out-of-pocket spending or reduce it? These kinds of questions can be, this kind of information can be useful, and state staff and legislators and others at the state level can use this to assess the impact of these various financing options that need to be looked at to see what it might do to the budget before we implement those kinds of things. And so we're really excited about not just having used that for the products that we looked at now, but as we go into the future, which will sort itself out as everything gets kind of put together for the new administration, we see an opportunity to take a look at more options out there, and using this model, we're going to be the only state in the country that has that kind of tool to really do good analysis. So I will stop at that. You'll hear more about all of this as we go through the day. And I want to thank the Commissioner again for the time and the support. And we'll move on to our keynote.
Thanks, Lorraine. Well, now it is my pleasure to introduce Vince Bodnar for our keynote presentation this morning. He's recognized as one of the leading long-term care insurance experts in the country and is highly respected for his visionary work to find new ways to pay for long-term care. Vince is the Senior Vice President of Project Management at Genworth Financial and since 2017 and really is primarily responsible for new product development. Prior to joining Genworth, he led several actuarial consulting practices focused on long-term care, including the Long-Term Care Group, Willis Towers Watson, Milliman, and KPMG. And he served as chairman of the Intercompany Long-Term Care Insurance Conference in 2007 and 2011, and has twice served as chairperson of the Society of Actuaries Long-Term Care Insurance Section and co-chair of the Society of Actuaries Long-Term Care Think Tank. He was recently named one of the 20 most creative people in insurance by National Underwriter, and please join me in welcoming Vince. Thank you.
Yes, I think yeah, that whole creative and insurance thing, it just usually doesn't go together. So. And then throw in actuarial. But I'm really thrilled to be here. If you didn't catch on from the introduction, long-term care is something I'm very, very passionate about, and particularly innovating in this space. I recently looked at an article I wrote in 2005 talking about the absolute need to change the way long-term care insurance works. People just weren't interested in the same old mousetrap, yet we continue to roll out the same thing. And now here it is in 2018, and we're still struggling with that. We have seen a lot of innovation, and I'm going to show you how we've had really 3 waves of products, and I think we're in the middle of sort of a second wave of products that are starting to take hold, but we still have room to innovate. So our excellent compliance people and legal team at Genworth made sure that I put this disclaimer in here. Although I do wear a Genworth badge, these views that you are going to see throughout this presentation are really views that I have formed on my own. Some of the research is research I've done personally, and also I'm calling out research that I have been a part of through my role at the Society of Actuaries. And so, again, don't necessarily take this away as Genworth views. And so I'm going to first, and I think we're all familiar with the need for private financing in long-term care. I'm going to briefly go through that. I found some statistics recently that I would love to share with you because I found some of them quite shocking. I'm going to talk about what I call traditional long-term care standalone. I've affectionately called that long-term care 1.0 or LTC 1.0, kind of like the iPhone 4. So I'm going to talk some about that, and I think that's what we think about mostly when we think about long-term care insurance today. Then long-term care 2.0, which is the combo insurance market, which is really taking off, and I think is where we're seeing a lot of innovation today. And then I'm going to talk about long-term care 3.0. We are seeing some interesting things emerge on the horizon, new ways to finance long-term care both within insurance and through social programs. And so I'm going to talk about that as well. About half of my presentation is going to be on the 3.0 stuff. So just the need for private long-term care financing. Again, I think all of us in this room agree that it's needed. But when we look at it, we have really an unsustainable situation. We have an aging, unprepared consumer that really doesn't understand the need to finance long-term care. And we have really a demographic winter coming where we have this huge wave of people that are going to be needing care in the next 20 years, and very few people around to provide it. So we don't have the infrastructure either. We're seeing, as you know, a growing number of older adults, which means we're going to be at just sheer volume. We're going to have more need for care, and we about right now, from all of our actuarial analysis that we're seeing on our books of business, about half of the people who are currently age 65 will need some kind of formal long-term care services before in their lifetime. And so we have this growing number of adults, and yet we have a growing shortage of formal caregivers. And so this really impacts family caregivers or informal care. About 117 million people will need some form of care by the year 2020 versus about 5 million formal care and about 45 million informal care providers. So we have a real shortage of labor. And what we're finding is that there's a real cost of being an informal caregiver. So this is a family member who doesn't get paid to provide services usually. They're saying that they're losing their own income. They have to take time off of work. And they're self-reporting that that's about 33% of their income when they have to do this. And a lot of them go out of their own pockets to provide care. And on average, when you do go out of pocket to provide care for a loved one, it's about $10,000. Most people, again, we have this high exposure to the risk, but very few people are preparing to pay for it. These costs are quite high, and Minnesota is actually, these are the national averages, and Minnesota's costs are even higher. But right now we see about $4,200 a month for a home health aide, $4,100 a month for an assisted living facility, and that's the national average. I have seen assisted living facilities cost $10,000 or more a month, and then about $8,400 a month for a private nursing home room. So these are really expensive costs, and the average cost of a long-term care event. So when you do need care, you'll need it for many months. So on average, it's $170,000, and the 75th percentile of cost is $230,000. So there are 25% of people in the population or that need care that are going to go above $230,000. And yet, less than 7% of adults have any kind of formal long-term care insurance right now. The other shocking statistic, this one is almost unbelievable, but the average person has about $135,000 in retirement savings by the time they get this age range of 55 to 64, and they have about $108,000 in debt. I had no idea that near retirees had this much debt on average. And so yes, they have these assets, but they also need to deal with loans or other debt. And we're seeing a rise in bankruptcy for people over 65, and healthcare out-of-pocket costs are the #1 driver. So those are a couple of statistics that I was really surprised by. And of course, we don't really see a willingness to create a fully funded, comprehensive long-term care insurance program right now. In fact, we don't have enough money to pay for the programs we have today. The Medicare Part A trust fund will be depleted by 2026. And so I'll spend a little time on LTC 1.0, traditional standalone long-term care. And I heard, Steve, you called this TRAD LTC. So I had never heard it called that. So traditional long-term care insurance 1.0. So just real quick, features. It was first introduced in the U.S. in about the mid-1970s. Early versions paid very limited benefits for just skilled nursing home stays only. They were called S&F policies. They were really, the modern version really emerged about 30 years ago, and they were patterned after U.S. disability income plans. So if you're familiar with disability income, long-term care insurance looks and works very similar to that. Most of them have a very defined benefit trigger, 2 out of 6 ADLs, and you qualify for benefits. Once that trigger is met, usually you're reimbursed up to a daily maximum amount per day, and usually it's based on where you're receiving your care. Skilled nursing facilities, now called just nursing homes, assisted living, or qualified home care professional, there usually are defined providers, and there's usually a benefit amount that corresponds to that provider. Some do pay just cash, just have to prove that you're disabled, and you'll get a check every month. There's usually a specified maximum amount that the policy will pay over your lifetime. And so we call this a benefit period. And then there are elimination periods, which is the period of time at the beginning of your episode where care is not covered. And then back in 1989, regulators, in their wisdom, decided that we needed to have a mandatory option of a 5% inflation protection offer. So if you bought a policy for $100 a day, you had to be offered the ability to increase that by 5% a year forever for your entire policy's life. It seemed like a good idea in 1989. But we now see that was probably a little bit high of a number. A lot of people who bought these policies in the 80s and the early 90s have benefits that exceed the cost of care. And it's been really a problem for the industry today to deal with that. And these products are issue age rated. Premiums are supposed to be and actuarially priced to be level for life. So you buy a product when you're in your mid-50s, that premium rate is supposed to stay level for life. It's guaranteed renewable, which means that as long as you pay your premiums, the insurer cannot cancel your policy. And so it doesn't have a term like medical insurance or homeowners insurance. When you buy it, it's a contract for life. And premiums can be increased if there is actuarial justification for those premium rate increases due to experience deviating from what was expected or other actuarial assumptions not playing out, such as interest rates and longevity. The sales for this product really did very well in the 1990s and all the way into the mid-2000s. This was one of the fastest growing segments of the insurance industry. And so here we see annual new premium in millions. So this industry topped out at about $1.2 billion of new premium issued per year in 2003. But then the market really crashed, and it has been slowly shrinking since 2004. This really was spurred on by rate increases as carriers realized that interest rates were not going to be 8%, as they realized how long people were living, and also some other factors that came in caused premium rates to be increased on in-force books. And then on top of that, regulators introduced what we call rate stability, which really made initial premium rates be priced even higher. And so that really put, for new sales, the rate increases kind of scared off a lot of consumers, and the premium rates went to a level that we believe was unreachable by the mid-market. And so in 2018, which isn't over yet, so I'm doubling what we saw through the first half, we're now down to about $150 million. So we're just a little bit north of 10% of the market that we saw in 2003. When you look at the market leaders, you can just see that this is really across the board. So I'm comparing 2017 to 2018. These are the top 10 carriers, and I think we really know that the market has declined. When you look at the Knights of Columbus, which never really wanted to be a market leader. Is anybody here from the Knights of Columbus? I don't think they ever. I'm in the Knights of Columbus, but I don't know. I'm not with the company, but I don't think they ever knew that they were going to be in the top 10. They are, and you can see that with the exception of 3 carriers, these sales have declined. And the other interesting point is long-term care specialists, who are agents that specialize in selling long-term care, really are only selling for 3 of these top 10 carriers now. The number of LTC specialists has really shrunk in the last 5 years. And so that's just Mutual of Omaha, Transamerica, and Genworth. All these other carriers on here are primarily selling the long-term care products through their career agency distribution, which is selling multiple products. So it's really just part of a planning tool that they're using with their customers. Whereas the LTC specialists were out looking for long-term care insurance sales. So what were some of the challenges that we saw? And I touched on some of them already. And really, we had some emerging environmental factors that we did not envision as actuaries in the 1990s. and it hurt our pricing and profitability and sales. So we were pricing at 8% interest back in the late 1990s. That was a good interest rate back then. It's now about 3%, and so that alone has been really just when you look at the way the benefits are designed, you're charging someone premiums they buy it when they're in their 50s for an event that's going to happen 30 years from now, and just the magic of compound interest, if that's not there at 3%, you're just not going to. The low premiums you were charging are not going to be able to cover the costs. Low lapse rates, much lower than we thought. 5% seemed like a really reasonable lapse rate back in the late 80s, early 90s. That was much less than what we were seeing on other senior oriented products. It's now 1%. I would even say 0.5% per year. So this is the rate that people voluntarily drop their policy. We're seeing increased longevity. I think we've seen about a 5 to 10 year increase in lifespans since the product was first thought of, which is, it all sounds good on the surface, but when more people are surviving to the point where they need to trigger their benefits, it's not actually not good for the insurance, the premium rates that were charged. We're seeing care delivery evolve. When we first started pricing these products in the late 80s, early 90s, we really didn't have assisted living facilities. And so now we do. And we're seeing that about half of people who need facility care are receiving that care in an assisted living facility. And so they tend to be a little healthier when they're going into these places, and they're living longer, about twice as long as people were living in a nursing home. So the amount of time people are on claim has really increased as a result of this. Regulatory uncertainty about the ability to get premium rate increases. I think the industry learned that, it might be actuarially justifiable to raise your rates by 150%, but it's not politically practical. So we learned that, and so you can't automatically count on these premium rate increases. And then carrier exits. We had over 100 carriers enter this market. I think there was about 175. If you go and look at the NAIC reports, but now we have about 10 carriers that are really focused on selling here. And the distribution contraction. I think there were about 20,000 or more long-term care specialists. We're now down to about 2,000. It's a hard number to know for sure. It's just my guess based on the volumes. And wary consumers when it comes to LTC 1.0. It used to be a smart buy. Now it's a risky buy for a lot of people. We'd like to change that, but that's just really the way it's viewed. And so when you look at new premium rates, and you can get this information from the Broker World survey, this is the same plan design, a 3-year benefit period with this 5% inflation option. It started out, if you were issue age 60, which is the middle row, it was a little less than $2,000 a year to buy this product, which your agent would have told you would probably be adequate coverage or close to adequate coverage. Now that premium rate is close to $4,000. In fact, this data is 3 years old. It may even be higher than this. And so these products have become expensive to buy at issue. And so I was at a rate hearing in Pennsylvania a couple of years ago, and one of the comments we received from consumers and policyholders was, is LTCI only for the 1%? And that was a really profound statement. I think everybody in the room just kind of gasped and looked around and thought, well, we didn't mean for it to be, but maybe it has become that. And so we think that this really forced me to go back and think about other ways that we may be able to tackle and address the middle market. And so I'll now move into the LTC 2.0, combo LTCI. And these products have been around for a while, actually. I think the first accelerated death benefit product, which had a long-term care feature in it, I can remember reading about them in 1989. So they have been around for some time. I think their appeal has really taken off recently. And there's two different variants of it. You have a life insurance combo product, which is often it's just a rider that's attached to any type of permanent life insurance product. Yeah, the insured, in most versions, the insured can accelerate, all or a portion of their death benefit when they need long-term care. And like the LTC 1.0, you have to meet this benefit eligibility trigger, which is often the same trigger that you see in LTC 1.0. So the inability to perform 2 out of 6 ADLs. And usually you can accelerate a small percentage of your face amount or your death benefit. So usually it's 2 to 4% per month while that death benefit is available until it's exhausted. And sometimes there's a residual death benefit that's kept behind to make sure people don't completely exhaust their policy. You also have an extension of benefits option on many of these products. So if you wind up using all of your face amount, you can continue to receive long-term care benefits beyond your death benefits. Sometimes these are 2 or 3 times the death benefit. So really your face amount becomes a deductible for this additional benefit that's available to you. There's what we call a chronic illness variant of this, so it doesn't quite qualify as a long-term care insurance product, but it's close. So it's not regulated as long-term care, and it can't be marketed as long-term care, but it essentially provides virtually the same benefits. Agents are not required to have long-term care sales training, but these products are fairly limited in what they can offer. You cannot have an extension of benefit option, and you can only have a cash reimbursement type product. There's also deferred annuity combos, which we didn't really see them take off as much as we thought they would when they first came out, because interest rates had really gotten so small that it was hard to fund these products through the interest crediting on a deferred annuity. But we're seeing them start to come back with interest rates rising. So basically, most of these are single premium deferred annuities. The customer buys an annuity. The account value is available for long-term care benefits if you need them with no surrender charge. In some cases, an additional benefit like your extension of benefit rider on life insurance is available on an annuity. So if you go through your annuity account, there's an additional benefit available. Again, the eligibility and the payout is very similar to combo products. And they're typically financed through the monthly account value charge or a reduced interest credit on the account value. Immediate annuity combos is something that we saw in the early to mid 1990s, and we haven't really seen too many of them recently. Although I'm beginning to see some of these appear on the drawing boards again. They're issued to you when you're healthy, and this is a payout annuity. And so you give the insurance company a lump of money, and they give you a payment every month while you're healthy. And if you need long-term care or you meet a long-term care eligibility trigger, your premium payment increases, usually doubles. So if you're getting a check for $2,000 a month from your annuity, if you need long-term care, it goes up to $4,000 a month. And it's usually just financed through an additional single premium at issue. Again, I haven't seen many of these lately, but I'm seeing producers ask for these now. So we're looking at a couple of possibilities here. So how do these products appeal to the consumer first? First of all, they're generally easier to understand. If you remember that first page on LTCI or LTC 1.0, I had to describe elimination periods, benefit periods, daily benefits, all that. Really, when you just tell a customer you can use your death benefit to finance your long-term care, if there's some restriction on it, that's actually easier for them to understand, we've found. It's also cost-effective. If you were already going to buy a life insurance policy or an annuity, the incremental cost to adding these long-term care features is really small, particularly compared to what it would cost to buy a standalone long-term care product. And then the appeal is the immediate value. People will have their death benefits and equity build up in the product, whereas you don't have that with long-term care insurance. You have this use it or lose it feature in long-term care, which we have found through consumer studies is something consumers find as a negative. Here, you'll get something. You can take your cash out, or you'll get paid a death benefit. For carriers, carriers really like these products because it really mitigates a lot of the risks that we have with LTCI 1.0. Your exposure is limited to the life policy's net amount at risk. Plus, if you have an extension rider, you're exposed to that too, but it's greatly mitigated. We found that the insured's equity in its base life policy acts as kind of like a copay. People are, we think, less inclined to use their policies if they know they're taking from their own policy values. That's really, we just see evidence of it. It's anecdotal evidence. I think we've yet to kind of nail it down to, it's 20% less. But we do see evidence of it. And then, long-term care insurance has very low mortality rates. So people who buy long-term care insurance have incredibly long life expectancy. Maybe it's just because they're good planners. We don't know. But it has continued to baffle the actuaries. And that actually helps with a life insurance policy. So, those two risks really offset each other well. They can be easy to distribute too, and you'll see that on a slide or two. You can add it on to a base policy, the life sale. It's usually someone that was going to buy a life insurance policy. Let's add this on. But you can also sell it as an LTC solution. We also see there's decreased regulatory reserve and capital requirements for the insurance company as well. So carriers like these. So we spent some time at Genworth, and this is from some of our internal research, just trying to understand, so who buys LTC 1.0 versus LTC 2.0? What makes them different? And first of all, we find that anybody who buys any long-term care insurance, in the last 5 years, they tend to be on the affluent side. So really, the inclination to purchase long-term care coverage is real strongly correlated to income and assets. But we found that the even more affluent tend to buy single premium combo products. We're talking people with assets over or household income over 250K. They tend to like this. And we use the phrase lazy money. This is money they had already sitting around. It wasn't really earning a lot of interest. But they see a lot of, they're very interested in taking some of those assets, moving them over into a single premium combo product. And now they're getting a better rate of return, and they're getting leverage from their money in case they need long-term care. We find that consumers over the age of 55 are less interested in what we'll call recurring premium combos. And these are, not single premium. You're paying a premium annually, because they look at life insurance as something they don't really need anymore. I don't need life insurance. My kids are, grown. I really don't need to worry about that, and I already have term life insurance. But without prompting, most people don't plan on addressing long-term care until they're about 55, unless you really poke them and I wouldn't say scare them. But unless you show them what's at stake, most people under the age of 55, it doesn't show up on their radar. But when you do educate them, they become interested in combo products because they solve other immediate needs. Most people under 55 are interested in life insurance. They are interested in savings. And so combo products that combine those elements and help them plan for long-term care are more attractive. Now the challenge is, what can they afford? Usually when you get down to the millennial generation, who we're finding are really good planners, by the way. I think we scared them really well. They want to plan. They're very risk averse. So all that helicopter parenting kind of paid off a little bit. But they don't have the money to buy it right now. So they're paying off student debt, and that's their primary concern. But this is something that they're now, when you make them aware of it, they say, wow, that's something else I have to worry about? And they start thinking about it. But they just don't have the money to pay for it. What we have found that the real driver of what products people will buy between 1.0 and 2.0 is the type of advisor that was used, that they're using. So LTC specialists the shrinking number of them will favor the standalone, the LTC 1.0, because they'll say that it's the best leverage for your dollar in general. I don't want to generalize everybody. And then financial advisors will favor the combos, with the asset-based advisors, favoring single premium. Although I heard an interesting exchange this morning, perhaps not. And life insurance agents, they prefer the simple riders, particularly chronic illness, because they don't need the additional licensing, and it's an upsell on a life policy. So they're primarily out looking for life insurance prospects, and then they'll use this as an add-on. And so when you look at sales, again, if you remember that the 1.0 is gradually going down, but combo is going up. And I've actually handicapped the combo sales here quite a bit. If it was a single premium product, I divided the premium by 10. And so the real volume of combos in 2017 was $4.1 billion. So that is almost, it's 3 to 4 times the peak of LTC 1.0 sales. What we're seeing, again, the trend in 1.0 is carriers are exiting the market. And in 2.0, we're seeing more. We see carriers wanting to get in. So it's a completely opposite trend. And when we look at sales leaders, we see, again, the combo products, as I said, are generally not sold by LTC specialists. They're primarily sold by existing distribution systems, with the exception of MoneyGuard, who did I think it was a genius thing where they actually trained and did their sales material all around positioning MoneyGuard as a long-term care solution. So, and so they are the market leader right now. They sell through multiple channels. I hope I have this right, Steve. You can tell me if I'm wrong. And what we see is these carriers, again, these are mostly household name, companies, and they're selling through multiple channels, which is I think it's a good thing. So they're finding multiple ways to reach their customers. And here I just put the key up here. We have everything from independent agents, career agents, broker dealers, and registered investment advisors selling combos. And this stat is based on 2016, but about 70% of the premium, which is only 11% of the policies, was the single premium. Okay, so I thought it was good to ground you in 1.0 and 2.0 so that we can move into 3.0. And so again, I think there's some really interesting things going on. Again, the need exists. So to figure out where we need to go with innovation, we have to answer a couple of questions. What would encourage consumers to plan better? I think that's really the primary thing. What I've seen in multiple focus groups is once you tell people about this problem, they want to do something about it. But if you don't prod them to think about it, they're not. And so what can we do to get people to plan better? The other thing we have to think about is that care delivery is changing. When we all need care in anywhere from 10 to 40 years. It's not going to look like the care that we see today. It can't, and I'll explain why. So we have to think about that as we design financing platforms. What role could the state and federal governments play in private financing? I think it's really important that private industry and the public sector look at this as a partnership, because I don't think it's possible for either one of them to solve the problem completely. And if we don't work together, we're not going to come up with an ideal solution. And then what risk would carriers be willing to take? We certainly know that many carriers don't want to take the same risk that they had been taking in the past. That risk of unlimited benefits with inflation protection really didn't work out so well for the industry. And so we're seeing a trend to kind of contract what benefits are provided and get a better handle on the risks that they're taking. And then, what solutions could actually work. So you have to find out, would people actually buy this? And, what would the premium rates be, and would people actually buy it? So thankfully, there's been a lot of work done in this area in the last couple of years. And so without prompting, when you ask somebody who is just retired or getting ready to retire, what's your biggest fear about retiring? The thing that pops up is high medical expenses, which when you unpack that really is long-term care. So that's one of the people's biggest fears about retirement. And then the second thing is that when you ask them, okay, well, you know that there's something you can do about these high medical expenses, private financing amongst consumers is strongly preferred. Most people agree that it's an individual's responsibility. Most agree that owning some kind of private insurance would be great. 51% don't trust the government to run a long-term care insurance program. So that's a stat I didn't. That's not my opinion. Now, so these are two things that would point to, so people want to do this, but then we find out that people really don't know that much about it. Most really have no idea how much it's going to cost. Only 20% have any idea what costs are in their area. And then once you tell them how much it costs, all of a sudden, well, I have other things to do with my money, so I'll just kick the can down the road. That's really what we're trying to deal with. So the AHIP did a really great consumer survey, which they released last year, and they really dug deep into why people buy, why people don't buy, and what makes people different. And the number one reason people don't buy long-term care insurance of any kind is because it costs too much. That's about 80% plus. It just costs too much. The other thing is they don't know if it's going to cover, and these are in order of reasons why. I don't know if it's going to cover the kind of services I'm going to need in the future. I just don't know what's going to be available then. The other one, I love the one, third from the bottom. I'm waiting for better policies. And hopefully as an industry we can deliver. And then all the way close to the bottom, but it's still almost 40%. It's confusing. And I know this. These sales I've sat in on a couple of sales presentations to clients, and it's hours and hours, multiple visits. And a lot of it is because of how confusing it is. And so what would make people want to buy long-term care insurance? What are some of the things that would make them more inclined? Tax favorability comes right up to the top. Over 90% said if I could deduct the premiums from my income tax. The second biggest thing, I think, which has really hurt the industry, is if I were certain that premiums that I would pay would not increase over time. The lack of clarity about the government role, if that became more clear, they would buy. And I think what this means is, how do I know if I'm buying something today, is it still going to be relevant in the future? The other one is if I could use non-taxable funds, like from their IRA or 401k to pay premiums. The other one is if the policy was sponsored by and could be purchased through my employer. We did a lot of research on that and found that there's some interesting reasons around that. We found that, again, attitudes are more important than demographics. This is about attitudes of wanting to buy. Forget about actually people who do actually buy, but just wanting to buy. Usually people who are really interested have had an experience and with family or friends. And I think you're going to see this segment of the population grow. I think it's actually hard to find somebody today who does not have a long-term care story to tell that's moving, like a moving story. Whereas 20 years ago, I think it was not as common as it is today. The other is people will perceive that they themselves have a higher risk of needing LTC, which, by the way, we found that people aren't really good at predicting if they're going to need it or not. It really, within the next year or two, maybe, but if you go 5 to 10 years, people really just don't have any idea whether, they may have a fear about it, but it doesn't correlate with the event actually happening. They're worried about the rising costs of premiums, so they know that if they buy now, it'll be cheaper. They'd rather buy something that pays for some coverage rather than none. And then there's a whole list of things that just little attitudes that make them more interested in planning. And I'm not going to read through them all here. Hopefully, is this deck going to be available to everybody?
Yes,
Okay, right.
Put it on the website in another week or so.
And then how do people want to buy coverage? And this is through some of our own internal research and also the Society of Actuaries think tank research. Worksite pops up right at the top. So people want to buy products, insurance products in general, particularly health insurance related products, through their employer because they feel like it'll be less expensive. They feel like it'll be easier to get and enroll in. and they think that the employer has done some level of vetting of the insurance company. Like my employer would never let it, a rinky-dink insurance company offer this product to me, and so they have more confidence. But it's also really the ease had a lot to do with it as well. But the challenge here is, the average worker is below 55, although plenty of us are over 55 and are still working. But the sweet spot is under 55, and there's just this general lag of buying coverage. And then making it easy is really important. And certainly today's products are not easy to enroll in. It's, a lot of times there's underwriting, and the long-term care purchase, even if it is done through the worksite today, it's a separate enrollment process. And so we have to make it easier for people to get it. Direct-to-consumer is another one that came up, although I don't want to discount that a lot of people still want to go through financial advisors. These two popped up in the top two. If there was some way that they could purchase it online, they would do it. They would, but the more complicated a product is, the more they're going to want to talk to a financial advisor. And we've certainly engineered our current products to be extremely complicated. So they like to do their own research online, a lot of people, and then comparison shop. But I think also a lot of people would still, even if they had 3 products lined up and picked one, they'd probably call their agent and say, help me get this policy. So if we did want to do something completely online, it would have to be a really simple product, really simple. So that would be a challenge. When we look at future changes in care delivery, this is getting to be now 20 years ago. Care was delivered to people who were in the World War II generation, so people born between 1900 and 1924. Currently, people receiving care are in the silent generation, and just to that's born between 1925 and 1944. So just somebody famous in each of these 2 buckets. World War II generation was John Wayne. Silent generation is Clint Eastwood. Yes, I know we like to think of him as from the spaghetti westerns, but he's in his 80s now. I don't know if you saw his most recent movie. He's the age of people needing care today, and both of them have different attitudes. In about 10 years, 12 years, we're going to start, actually we're right on the cusp of it right now, but you're going to start to see more and more care being delivered to the baby boomers, and then ultimately Gen X. And so while this is happening, you're going to see the ratio of caregivers to care receivers drop dramatically. I mean, we're really close now to what it was at its peak, which was 7.2 caregivers to each care receiver. And that's beginning to drop dramatically. I think we're starting to feel this really hard now. And so these 2 things, the fact that it's going to be a new generation receiving care, and just the lack of infrastructure and care delivery resources, it's going to force a change in the way care is delivered out of necessity. And I also think just because the baby boomers have certain attitudes, they do demand change. It's going to be out of a preference too. And so when we look at another important statistic is that as our population is aging, we're not really seeing we're not really seeing people getting healthier. And I'm not surprised if you look at, although medical technology is doing wonders to extend our lives, and our procedures. We had some great conversations about how procedures are really making things easier to get the procedures done quickly and be less invasive. It's still, we're not eating as healthy as we used to. We're not as active as we used to. And I don't think, we may not have a pill for everything going forward. And so there's a concern that we might not, there might not be, we might not have the healthiest population going into the next. And so this is the prevalence of people with a disability over the age of 65, and it's steadily increasing. So if you look at the current care landscape, I've used this picture before, but this is what you think of when you think about long-term care today. What you see, is an elderly woman, in a wheelchair, in isolation, staring out a window. And it's really dismal when you think about it. who's receiving this care? Again, it's a silent generation. The informal caregivers are the baby boomers. The formal caregivers are generally Gen X. And then the generational dynamic about the silent generation is that they tend to accept things the way they are. Of course, there are some rebellious silent generationers out there, and we have a lot of them, by the way, as a society. But generally, they'll just take it. Like, okay, this is what's supposed to happen, and they'll go along with it. They generally don't want to burden their children, and usually their children are really busy and mobile. They may not even live close by. So they often find themselves, when they're needing care, in social isolation, and they'll accept the social isolation, which I think is absolutely sad and dreadful. They also are the victims of a low-tech health system. So our medical system is very low-tech. It needs to be more high-tech. And by low-tech versus high-tech, I'm talking about not the medical technology itself, but the interconnectedness of it, sharing data. It's just not there today, and it's even worse. It can be even worse in the long-term care delivery system. I know that industry is really making strides to make it better. I encourage all of you to go to a leading age conference sometime in the next year or two. They really want to change this about themselves, but right now it's got some catching up to do. And it tends to be delivered at home, or ALFs, or in nursing homes. So that's the way it is today, but there are forces changing this, and they're in place today. And what we're seeing in the future is that, again, within 10 to 20 years, we're going to see baby boomers become the care recipients, and they will demand change. They have through every aspect of their lives. They're going to do it. They're going to change. They change the way we eat, dress, retire, save, work. They're going to change the way we receive long-term care. They're going to demand it. They're not going to expect help from their children. They may get it. They might be surprised they might get it, but they're not going to expect it. They're not going to tolerate social isolation. Just won't put up with it. They're going to want to maintain their lifestyles. That is a really important thing to a baby boomer, is to maintain their lifestyles. And we're going to see some emerging tech, and we're seeing emerging tech. So we're seeing bio-wearables. And this is, I think, the Apple Watch is becoming like the wearable of choice these days, where you're getting your health monitored, and that'll send immediate feedback out to people monitoring your health. This other thing, this is something that came up a couple years ago, on-demand nursing. Just think about Uber, or you can dial up a car. What if you could dial up someone to come out and help you? And then we also see now. I know Steve laughs at the robot pictures, but in Japan, we're seeing robotics kind of catch up a little bit and come and play. Well, Japan has even a worse demographic problem than we do, and they're not afraid of robots like we are here. We have robot phobia here for sure. But I do think we're going to see assistive devices really on the rise here. Also, smart homes. We're seeing this all over the place. My house is almost completely smart now. I can unlock my door remotely. I watch who's coming in and out. I control my thermostat remotely. And now I want to start to turn my lights on remotely and do other things and really mess with my wife when I'm not home. But these things, if you think about it, are all things we're going to start to see standard in homes. And we think that this will enable people to stay home longer. We call them smart homes. And we're even seeing motion sensors, so you can pick up on if mom isn't getting around as well as she used to. We're seeing these communities evolve. So I think, again, if you go to a leading age conference, you'll learn that the word facility is never used. It's a 4-letter word. They like to call them communities or aging places. And so we're going to see them look more like this picture on the left, lower on the bottom here, where they're just open air, nice places, as opposed to what we saw on the previous page. And we're going to see some of these places in really interesting locations, but it's all going to be about, again, think of the boomers. I want amenities, I want mobility, I want social interaction. So I think that's a picture of an assisted living facility in Acapulco. So it's cheaper. So these are the things we have to think about as we design our products. I think we can't design products that are really configured towards a certain benefit, because in a certain place, because it'll be obsolete in 20 years. So we're looking at some, so we've covered consumer attitudes, emerging care. What are some of the things that we're seeing on the horizon, possibly for potential government programs? We're seeing catastrophic plans come up a lot as a potential social program, and there's 3 proposals out there which we've been looking at pretty hard at Genworth. And they're basically, they're new programs. They're essentially high deductible long-term care coverage. So we're talking large deductibles, something where you're responsible for your own care for 2 to 4 years. Then the government will come in and pick up the cost of your care, really replacing the Medicaid system. At least the Cohen-Fetter proposal, they believe, and I think because they've isolated the risk so much, that they could finance this through a small payroll tax, which is just 1%. And so again, because they've confined it to a catastrophic plan, we're seeing an idea come out from the Bipartisan Policy Center on the Medicare Advantage option. This is really just to get more people enrolled. And so these are small benefits that you could enroll in when it's time to enroll in Medicare. Increased tax favorability of premiums. That's another BPC proposal. Their proposal is that you can use your 401k to fund long-term care premiums penalty-free. It would be great if it could be tax-free, but it's penalty-free right now. And then we're seeing some movement in some recent events. And I know John Cutler is going to talk about Medicare Advantage plans providing long-term care benefits. And then a proposal just came out on Monday to expand some tax favorable contributions to health savings accounts. So some other things, and I'm going to have to pick it up a little bit here, but key considerations in plan design. You have to think about what people want, simplify the understanding of the products. You need to prepare and educate people on what to expect, both what they have to finance privately and what is available in the public. We have to find a way to remove the use it or lose it feature of LTC 1.0. And we have to focus on autonomy and living, not on, we start referring to it in a more positive way. And I think that'll get more people interested in the product. We have to, as I just pointed out on the last couple slides, you have to allow flexibility. When people are functionally disabled, you have to let them use the money that they are financing with in the way that is most appropriate for their level of care. People are interested in you helping and the industry helping them navigate the system. So they're not just interested in a private financing scheme where someone's going to help them pay for care. They want guidance on how to navigate the system, which is extremely complicated, and how can help them reduce their own personal costs, much like managed care plans do today. Carriers need to better box the risk. We talked about this. Carriers were showing more cost sharing and limits on the amount of coverage. We have to figure out a way to mitigate the long exposure to environmental changes in incidence rates, mortality, and interest rates. And we have to mitigate against these changes in care delivery. This is an interesting slide. I'm going to just go through this quickly, but I gave a presentation to an actuarial community in China in April, and they're really struggling with their long-term care system as well. And someone asked me, be prepared to answer the question, because they want to learn from the U.S., the good and the bad. What would you have changed if you could get in a time machine and go back to 1989 and tell all the actuaries how to do it different, or the insurance carriers how to do it different? What would you do? And so this is the list, and I would have changed. This is just my opinion, by the way. I would allow for annual changes in premium rates, and if this was sold with an expectation that it would be level for your life, which is really, when you look back on it, kind of a silly promise to make. I think other people are used to their medical insurance premiums going up and their auto and home owners going up. We should have got them ready for the possibility that long-term care premiums could go up. We would design them to be simpler. We would have include managed care provisions. I think that it'd be great if we could, as part of your policy, you got an annual health checkup or assessment and interventions and incentives to use providers like people are used to with their health plans. We don't have any of that right now in our policies, and it's been a challenge to adjudicate claims where we can't really give any advice. We're just there to pay claims as an industry, and it'd be great if we had more ability to help people. Again, allow cash values. We would have worked more closely, I think, with state and federal governments, again, to integrate some of the ideas that we had and better leverage what they could have offered. I think if we could have rolled out long-term care with tax incentives, it would have been a different story. And again, I'll let you read all the details on your own. So what are some of the emerging, so we are seeing some innovation. And so what are the emerging alternatives? I think you're starting to see combos get designed more towards the middle market, although there will always be that market for the affluent. I think you're starting to see recurring premium products. I think you're going to start to see carriers position the combo as a long-term care solution instead of a life product with an add-on, and really price them more for the mid-market. The care annuity, which is the way long-term care insurance works in the United Kingdom, it's a single premium immediate annuity, which is underwritten. So the less healthy you are, the more your payout is. So if you give them $100,000 and your life expectancy is only 3 or 4 years, then you can expect a payout in the $30,000 to $25,000 to $35,000 a year range. And so that's really helpful if you need long-term care and you're trying to not outlive your assets. So it works in the UK because people are used to annuities in the United Kingdom. Here we don't know what annuities are on average, so the average American doesn't know about a payout annuity. And so what we have found is that although it can reduce or remove the longevity risk, like outliving your assets, and people actually like it when they hear about the idea, we don't have any distribution systems that are focused on people who are at the point of needing care. There are no financial advisors that specialize on giving people advice at that really critical point in their lives. And so we found it hard to get people to know that this is here. About the closest thing we have are elder law attorneys who, of course, probably have different advice in mind. And then we find that most people can afford the average stay or that $170,000 average cost. Most people could afford that somehow. And if they could annuitize that money, they could make it last forever. The other thing we're seeing is life settlements. And I know this is somewhat a dirty word in the insurance industry, but basically you're selling your life insurance policy. And you get cash, and you could use that to fund your care or fund a long-term care product itself. So this is actually a growing, emerging industry again, but it's also suffering from, there's very few people in this distribution system. The other thing we're seeing that that has been successful are managed care programs. I'm looking at the actuarial experience of managed Medicaid long-term care. And so these are Medicaid enrollees who are placed in a managed care program. And I listed United Healthcare here. Sorry, I'm not trying to play favorites to a Minnesota local here, but just to make sure you know what it is. It's like United or an Anthem, or they're paid a capitation fee to manage the population health of a Medicaid population. And then sometimes those people will need long-term care. And so because Medicaid, through these managed care programs, has been managing their care, they're kind of on the know. They know when someone's going to need long-term care. And we found that their interventions are actually helpful. They're actually getting people at the onset into the right level of care and keeping them there. And so they have a higher propensity of people starting their long-term care episode out in the home and staying there. And then we see the same thing with continuing care retirement communities without walls, which we also call continuing care at home. This is a very small industry, but again, you buy into a membership and you pay a monthly fee while you're healthy, and then as you start to need, as you age, they're going to pay more attention to you and then get in front of a long-term care event. Hopefully delay or prevent it, but if not, they're going to get you at the right level of care and keep you there. And the actuarial analysis I've done in all this is that actually the average cost of providing care to people in these two settings is less. Not really seeing a real decrease in incidence rates. And again, most of these people are being kept at home, but we are seeing cost savings. and people actually like being in these programs. Again, it seems to be they're delivering high quality care at the appropriate level care, so it's cost effective. So the life stage concept is something that we've seen. This concept was tested by the Society of Actuaries. It was priced and consumer tested. It came out very favorable. And I'm going to let John O'Leary speak to this. He's on the agenda. So I'll leave that one. I'm just going to keep glossing over here because I am running short. Sorry. The other concept that came out of the Society of Actuaries long-term care think tank and through the NIC Innovation Subgroup was a contribution-based approach to long-term care. So I want to just caution you, this is a family of concepts, not a single product. But basically, it converts LTCI, instead of thinking of it like a defined benefit product, it's a defined contribution product. Much like retirement planning changed from DB plans to 401k plans, I think long-term care is eventually going to switch over to that as well. So basically, you're incented to put as much as you can away, and that plus some insurance leverage will determine what your long-term care quality is going to be like, just like your retirement works today. And so, again, just like the life stage, this went through some robust consumer research, and it looked very viable and interesting to consumers. But basically, just to help visualize it, as a person ages, you're contributing into what I call the savings fund, and that's your money. You get to keep that, as long as it's just your money. It doesn't go anywhere. On top of that, there's an insurance element. So this whole time that you're saving, you're buying insurance for the event that you need long-term care before you have enough money saved, and this will kick in case there's a long-term care event prior to that. And you could also purposefully underfund so that there's always an insurance level on top of it. And then when you need care, there's multiple ways it could be paid out. I mean, just like your 401k plan, you can leave it in there, you could take it out as much as you want, you could annuitize it, there's lots of things you could do. Same thing here. So this is really what I would call a contribution-based system to long-term care financing. And it really drives home the personal responsibility. The Society of Actuaries tested this. They really refined that picture, that nebulous picture that I drew, into an actual product. They called it Retirement Plus. And again, it's everything I just described. And it came back, it's very affordable. And just like Life Stage, about half the people who saw it were very interested in it, and then 38% were interested after they saw the pricing. The last concept I'm going to leave you with is what I'll call integrated long-term care insurance, and this is an example concept, and it's patterned somewhat after the way it works in France, and somewhat builds in some of the social programs that are being proposed these days. So if you break your lifetime formal costs into 3 buckets, so this is the cost that you will spend for long-term care as a person. The first is 0 to 50K, and if that can be covered by your medical plan or your Medicare Advantage plan, first of all, 70% of people will never break through that threshold. So half of people will never incur a long-term care formal cost. But then those that do, again, another 20% will stay under 50K. And what we see in France is that this part of it is covered by their medical plan. And it's great because the medical plan is already vested in your wellness. And so for other reasons, they're trying to keep you healthy. And then as they see someone start to need care, they intervene and they get people in the right level of care. They're very incented to do that. And because they have the data and the medical history of the person, it saves a lot of time and effort. And so, and the plan is incented to use the care in the most cost-effective way. So if we could start everybody else out in this setting this way, and it wouldn't add that much to the cost, by the way. If you could do that, now the other 2 layers benefit from getting the claim or the episode started out on the right course. So if the next layer which was 50 to 250K, were covered by private financing. Now this is 30% of people will exceed that 50K, including 12% will be over 250K. So this really will address the majority of formal care episodes that go beyond 50K. If they could, so people could choose to finance this or self-insured, whatever way they want. So this would be the space for private long-term care insurance or not. Again, the care coordination established in the first layer could be leveraged here. And so people are already at home. They've got a good system in place. We just need a way to pay for that. That care coordination would continue. And it would be great if you could share data between the two plans. I know HIPAA, there's good motivation behind all that, but sometimes it just gets in the way. I can't tell you how much data everybody has on me, except they don't know that I went to the doctor last week, and I really don't care about that. But for some reason, no one can know that, but they know my credit history and where my kids went to school, how much my house is worth, but I wish we could just break that down for this. It would really benefit that second layer. And then possibly you could means test premiums with subsidies here. And then over 250K would be that social insurance program, which again is a minority of people. And if you could make that compulsory, and it benefited from the two other layers of care, I think it could be very cost effective. So that's an idea that's been gelling in my head as I'm looking at possible solutions, again, in China for a couple of reasons. This bubbled up as something that, what heck, this could work here. And I'm encouraged by some of the stuff I'm seeing with Medicare Advantage today and these public program proposals. So that's the last idea that I will leave you with. Hopefully this was helpful as you spend the rest of your morning and early afternoon here together, just plant some seeds. I'm happy to take a few questions, if that's okay.
Yeah, why don't we go right into questions?
Okay.
Thank you. I've been working for about 3 or 4 years on issues related to older adults that don't have family support. And one of the things that's showing up in that is that the whole definition of care has not pulled out the decisional piece, that when you don't have a family to help you with decisions, who's helping you with that? And I'm curious whether you would open your exploration to expanding what would be covered to things like navigators, care managers, healthcare agents, that sort of thing, because those things are going to be highly needed by this large population of these solo older adults. And what I found in my interviews is there's a heck of a lot of boomers out there that are simply saying, I don't want my family involved.
Yeah, well, I would say that, first of all, you're calling it a navigator. I would call it that care coordination, just someone that helps the person receiving care navigate it, get the right care in place. I think that's going to be a really critical part of any financing scheme. It's almost as important as the money itself. But I would urge any baby boomer to start planning, and that involves talking to your family, and if they have to know what you're going to want to do.
But that doesn't work for people who are solo older adults.
Yeah, if you don't have any family, then you're going to have to find a trusted friend or somebody that can help you with that.
Those folks are not necessarily out there right now.
So there's other interesting solutions where your plans can be parked in a vault someplace in the cloud, and as long as that gets to somebody. The whole thing is your wishes need to be known before it's too late.
Question. Obviously, starting younger is cheaper, and that makes sense, but baby boom generation is already aging. Do you anticipate any of these new policies or even existing policies will be affordable to baby boomers, say, 60 and older, or has the train already left the station for us?
I think there's still some good solutions for people who are boomers who haven't bought anything. If you've accumulated assets already, I would say, look at how they're deployed, and maybe position some of them to finance long-term care, or earmark some of them to finance long-term care now. To the extent you don't, I would say something is better than nothing, and so buy something that'll help later, whatever you can afford. But yeah, I think some of these solutions will apply. Sorry.
Thanks. question for you. As you're thinking about innovation and looking at your different groups, I know a while back, one particular carrier had tried to think of a way to integrate long-term care into disability insurance, where the disability was while they're working, and then those accumulated premiums moved forward into their retirement years, and those were kind of made up as part of that
Right.
going forward, and that huger bucket, right, would maybe offset some of those long-term care costs. What's happened to that, or has that just kind of gone by the way, or it didn't work?
Yeah, I remember seeing the idea. I don't remember if a carrier.
It was a Unum policy.
Was it Unum? Okay. All right.
Late 80s.
I think we have time for one more question.
In your list of things that didn't quite work out, or items that you wish you had changed looking backwards, would it have helped, or would it have been reasonable to have a minimum employer contribution or a participation level instead of making all of the group or worksite delivery completely voluntary?
We did some of that. Where there was a modified guaranteed issue. I mean, Genworth still does that today, but there was just a true guaranteed issue version back in the late '80s, early '90s. It didn't turn out really well. So, they had to have some element of health screening before they could issue the policy. What happened was a lot of carriers bought a lot of claims. So there has to be some element of risk selection.
How about on the premium side? If there had been a minimum contribution level on the premium side?
That was tried. So and again, you still have those today. They call them core buy-ups, where the employer buys a small long-term care policy for everybody, and then you can elect a buy-up. It still doesn't. So everybody's got a small guaranteed issue policy, but very few people still choose the buy-up. So.
Well, thank you, Vince. I sure learned a lot, and I think everybody here did as well. So let's thank Vince.
I know her, we go way back, and the work that she does at the SHADE Act is great for the state and great for all of us. So we're looking forward to what you have to say about this, the new tool, the model.
Thank you. Thank you so much, Lorraine. And I have to say that I now I just hired my own intern who graduated from the Humphrey. So we're playing it forward.
We're playing the same thing.
So thank you so much. So I'm really delighted to be here. We've had a great collaborative project with Lorraine and her team. My research center is called the State Health Access Data Assistance Center. That's a mouthful, but SHADAC. And we're located at the university. We do a lot of work around data and information and leveraging what we know and what we can find out about different policy issues and help states with health reform, long-term care, and Medicaid. So that's kind of our focus. And we worked here with Lorraine on long-term care, the projection model, which I'll talk to you about today. So as you know, Minnesota Own Your Future had a few objectives. One was education and awareness and to make sure people knew about long-term care future needs. They're working with a team of consultants on product development to provide new innovations in the state of Minnesota, and then aligning the Medicaid program to align with those incentives for the private sector. And so that's part of what we were doing is what is the role of Medicaid and what do we know about the Medicaid financing of long-term services and supports. So this audience, I probably don't need to show this slide, but it's very helpful, I think, to note this is the cost of the Medicaid program. So the elderly represent 5.5% of the Medicaid enrollment, but a significant share of their costs. So as you can see, the average per capita cost is $13,000 a year per person. That gold, University of Minnesota Gold, thank you, Tom Devine, represents the nursing facility cost. So it's really driven by long-term care nursing facility spending, and children and adults on this side are pretty low cost. which is another point I make for other meetings with the legislators. Like, you're not going to spend a lot of money with adults and kids. It's the disabled and long-term care. This is a chart that shows long-term services expenditures as a large and growing share of state budgets. This is across all the states. That top line is total healthcare spending. The institutional is in the middle, and you can see on the bottom the growth in home and community-based services. And across the country, states are moving to get people out of the expensive nursing homes into supported care environments. Minnesota is one of the leaders in this, but you can see that uptick in home and community-based care on the bottom of this slide. This is Minnesota's aging population. So the bottom chart, the bottom line is the elderly population growing. The middle line is between 18 and 64. So this is kind of complements our earlier talk about the baby booms. Baby boomers are growing. The younger people are decreasing in proportion of the population. And by 2050, 1 out of every 5 people in Minnesota will be over the age of 65. This is rebalancing Minnesota's use of nursing facilities. This doesn't look like a huge decline, but it is considering where we started and considering where other states were. And the point is that Minnesota has been a lead with their elderly waiver program, the alternative care program, and state-funded essential community support, so that over time have funded home care to reduce the nursing home facility use and support individuals in their homes, where for the Medicaid program it's significantly less costly. So our model was to work with Luray to think about what are the use and costs of long-term services and supports for the Medicaid population in Minnesota, to try to project out those spendings into 2020 and 2030 to say, what is it going to look like if we don't do anything? And then if we evaluated 2 policy options to say, can we alter these projections over time? Advantage of our model, we use Minnesota-specific data wherever we could. We had really good data on the Medicaid fee-for-service and encounter data from the Department of Human Services. So we really had good specific data on individuals, which the university gets quarterly and updates, and this is a really good use of that information. We also had Minnesota-specific demographic data. So a lot of times when you see national models, and as you heard earlier, Minnesotans have longer life expectancy. We have a different mix of home and community-based services. And so our advantage is to look at Minnesota as a unique state and with a unique population. For this model, our target population is elderly, age 65 and older. We excluded the disabled. The disabled are a significant cost to the Medicaid program, but there's different policies, different programs, and we just felt like we needed to take one cut at this first stab at this population. And we exclude acute care services. So we're really looking at that long-term care services and support component. So if you think about our model, we're looking at individuals age 50 and older in 2015, and we've got good baseline data on their costs and use of healthcare or long-term care services, and good information on their demographics, and then we're trending them out to 2030. So we're trying to say, what is this population going to look like over time? So our main data sources, I'm happy to talk about these data sources, but this is kind of what my research center does. We try to find good data and then leverage it for state policy purposes. So the American Community Survey is a national survey. It's replacing the decennial census. It has really good demographic data. We had the MMIS system, which gave us information on costs of long-term services and supports. The Health and Retirement Survey, which is a national survey which looks at transitions over time. For use of long-term care, caregiver support, home and community-based services. We have the Minnesota Health Access Survey, which provides information on health insurance coverage, the Survey of Older Minnesotans, and the Behavior Risk Factors Surveillance Survey. So a few notes on the data. So as you know, a significant part of services are provided through managed care organizations, and that does include the elderly 65 and older. And so about 60% of all the data that we got from the state is in managed care plans, even for the long-term services and supports. So that means we have encounter data from the managed care plan, so they have to submit sort of dummy claims or claims of the services that provide. But you should know that this is not fee for service. It's capitated in the managed care plan, and they provide information to the state on what services they provide. The nursing facility definition, we've really tried. This is one of the things that's kind of interesting about this project is that we learned there's a lot of in and out of nursing homes, both post-acute care after a hospital stay, but also just for a 2-week stay or a 5-month stay. And so we really tried to get at long-term service use of the nursing home and not the acute care part. So we defined, and this is something that we could change and alter, but as to get at long-term use, we defined it as a stay of 100 or more consecutive days, had at least one nursing facility stay in 6 or more months in 2015, so that's a 6-month stay or more, spent 180 or more days in a nursing facility. So we really tried to exclude the acute care and the short-term rehab stays. And I will just say that this kind of in and out of nursing homes is an issue, and it's super costly. And it's something that maybe the state wants to look at, but it would be different policy solutions and different ways to think about, what is going on with that use of nursing facility stays. This is our framework. So we start with our cohorts of individuals, and we look at sort of how many are going to die over that time period. So we're going from 2015 to 2030, so projecting them out. We're going to look at ADLs and how the ADLs transition. We have a measure of cognition and then chronic conditions. And then we sort of move through this model, and then we look at their income and assets and determine Medicaid eligibility, whether they have long-term care insurance, and then whether they use nursing facility or home and community-based care. So we're taking this population, aging them, and then seeing how they transition in terms of their cognitive abilities, their ADLs, and their chronic conditions. I don't expect you to read this, but I just want you to see this is the eligibility determination for Medicaid, long-term Medicaid for elderly. This is a pretty amazing, and Robert Hest, who's here, you want to wave, Robert? He worked on this and worked collaboratively with DHS, so it's pretty amazing. The main, I'll just say the main factor is income, but then the next sort of triage is whether you need nursing facility services or not, and then whether you have a spouse or not. So depending on all those yes or no questions, it takes you through this triage. But it's a pretty complex system, and I would just say that we as a state, and most states, limit Medicaid eligibility for seniors. So you think it's 100% of the federal poverty level, and does anybody know what that is? Except my students. Yeah, it's about $14,000 a year. So that's our limit on eligibility for long-term care. Okay, so we call this a cohort model. So we take a cohort, we put everybody in cohorts. So this cohort is 60 to 64-year-old males, white, urban, had 0 to 1 ADLs and not eligible for Medicaid. So everybody goes in a cohort depending on those characteristics. So age, sex, urban, rural, ADL, Medicaid eligible. So that would be our income. And then we trend them out to 2020 and then to 2030. That red line in the middle is Medicaid eligibility. So in this cohort, 2,500, we started with 70,000, 2,500 died by 2020. And then those two yellow cohorts on the top are Medicaid, people who had incomes eligibility for Medicaid. So those are the two cohorts we're specifically interested in. So then each of those cohorts, we predict whether they need nursing facility services, home and community-based, or no care. So now that we have this cohort of 21,000 who need Medicaid, we predicted who is going to need nursing facility care, who would need home and community-based care, and we match that up with our with our data that we have on the average cost of nursing facility care, which is $37,000 a year, and the average cost of a home and community-based care service, and we basically just multiply that out and then trend it forward. So as we move through this model, we churn everybody through a cohort, everybody through a projection model, and then attach the prices to sort of project what the impact is going to be on the Medicaid spending. Okay, so some of the results. So when we started, this is our baseline. So about 54,773 Minnesotans made claims for long-term care services. And the cost of that was almost $1 billion for 55,000 people. This was kind of an eye-opener for me. I thought there were more people. But when you take out the acute care and you take out, there's a lot of people on Medicaid that don't use long-term care services. So it's really a finite group of people. And we know a lot about them, which is also very interesting because we have the claims data from the state. So of those, the total cost for nursing facility residents was $620 million, and then home and community-based services was $370, which makes the total cost $991 million. And you can see again that even though I've said home and community-based services are on the upswing and Minnesota has more use of home and community-based services, the nursing facility really still drives the costs. This is the I don't know what that little smudge is in there, but this is just the distribution of, I don't know what happened here. Hold on. This is the distribution of that $1 billion, and the maroon part is the long-term care facility services, and that's 62.5% of the total cost is for nursing facility services. And then we have personal care, which is labeled there, and then customized living, adult foster care, and all other. So it's nursing facility care and the personal community care. That's the distribution of the long-term care services for those 54,000 people. This one's a little better. So this is the distribution of the community-based. So those that use home and community-based services, there's 37,830 people who use those. And of those, about 60% or 2/3 use personal care services. And the others are customized living, adult foster care, and a very small nursing facility snuck in there, and then all other. So this is just, again, to point out the distribution and the types of services people are using. So here's some of our projections, and these are preliminary results. We're refining some of the income categories, and so these might change over time, but I think we've tested them a lot of different ways, and we're pretty confident in the projections. And this is to think about if no policy is implemented and we don't change the service delivery, so it's based on what we have today, and no policies are changed. We have our current existing mix of home and community-based services and nursing facility services. This is our projection of how many people would need services. So it goes from 54,000 up to 94,000 in 2030. And then our projection of need for long-term care services, 12% for nursing facility, and 104% for home and community-based services. When you translate that to dollars, we project by 2030 that's going to grow by about 73%. So today it's about $1 billion. In 2030, it's going to be $1.7 billion. So it increases almost by double, but it's 73% of the spending. This is just a visualization of sort of our projection of the increase in costs over time in millions of dollars. So this is, the concern of the Medicaid program. Even with our current mix of home and community-based services, those spending is it's pretty significant for the state of Minnesota. So we evaluated two policies, which you're going to hear from the Johns. John O'Leary and John Cutler are going to describe their two policy options, but we tried to evaluate these two options. One was an enhanced home care benefit, would require all Medicare supplemental policies to include an enhanced home care benefit. So this is not a medical benefit; it's a social service benefit. So it's a non-medical chore service, service coordination, adult daycare. The idea is to try to keep people in their homes as long as possible. The maximum daily benefit is $100 a day and a lifetime benefit of $50,000. And it would be embedded in all Medicare Advantage and Medicare supplemental products. The life stage insurance product is a blended product. So we talked about this, I think that was it the 2.0, the combo product, which is life insurance combined with a long-term care insurance policy. And John O'Leary is going to talk more about that, but it's targeted for a younger population and then targeted between 35 and 55, and that policy would kick in when they're older. Now, we had to make some assumptions here because that policy is not in place right now. So we pretended like it was. And so what if this policy were in place and people had taken it up and bought this policy? And we made some projections on what the actuaries thought would be take up and how much would be taken up and who would take it up. So in the enhanced home care benefit and supplemental plans, we estimated that it would actually have a significant impact. And we estimated a 22% savings of the baseline, or about $360 million in 2030 dollars. So this again is a benefit that helps to prevent spend down and also provide services that may have been provided by the Medicaid program are now being provided through this mandated benefit, basically, in the Medicare supplemental products. On the life stage, we had limited, we didn't show significant results. We showed some trend in the direction that we were hoping, but we just didn't have enough years out. So we've been talking with John O'Leary about, can we go to 2040 or 2050, even 2060? And we're trying to figure out how we can take our model, which we feel pretty confident now, but how can we push it out further? And where that group would see some benefit, when they're older. So right now they're just too young to certain needs services, especially in Minnesota when we're living so long. So we really need to push that out a little bit longer. We think there'd be some results, but we just not in the current projections. So in summary, this is a state platform. It's state data on demographics. It's state data on costs of long-term care, use of long-term care, the current mix of services. We feel really strongly about using state data to do this analysis. It's been great working collaboratively with the state, not only with Lorraine's expertise, but having that micro data. And we have a programmer who knows the data really well and has worked with the state on helping set the rates for their Medicaid nursing facility rates. So having that expertise and being able to leverage that to do some analysis, kind of offline, but still informing the state policy decision makers. And then I would just again point out that disability is another driver that should be looked at. We just didn't have the time or capacity to do that, but we also have their spending costs and would be interested in exploring that. So right now we're working on refinements to the model. We wanted to have a little more flexibility in the income determination. We kind of run it through the Medicaid, as you saw, the complex Medicaid eligibility system. We'd like to have some ability to, like, what if there was an uptick in savings of the baby boom, the younger baby boom population? What impact would that have on spend down? Or if you had one of these reverse mortgages or some kind of savings insurance combo 3.0, what impact would that have on future spending? We also have some interest in looking at some of the social determinants of health, like food security and food stamps, which are really important to a low-income population, low-income aging population, and the state has that data, and we could incorporate that into our model. Whether you could provide food support to some populations, would that have any effect? And then also looking at medical advancements, we do have a variable on cognition, a pretty good variable, but what people tell me, like, what if there's, a cure for Alzheimer's within the next 10 or 20 years, what impact would that have? And the cognition is certainly one of the triggers for need for long-term services and supports, and that's something we could take a look at. So I just want to acknowledge my team, Giovanni Alcaron, Robert Hess, Mark Woodhouse, Benjamin Capistran, who is our demographer, and Robert's here. I have to run out, so if you have, I'm going to take questions now, but as the day goes on, Robert will be here. And then, of course, Lorraine and the Medicaid director who has now left, Marie Zimmerman, and consultants John Cutler and John O'Leary. So, thank you.
Thank you. So I know you have to run, and
Yeah, I can take some questions.
but let's take
yeah,
a few
yeah.
questions before you go.
Yeah.
So where are the people who are going to take the? Raise your hand if you have a question, and we can get a microphone for you.
Lynn, would your model be impacted by a recession? You know, there's lots of talk about a recession between now and or occurring in the next couple of years.
Yeah, so we basically based it on current rates of growth. So yes, it would definitely have an impact because we would project some income going down, and right, we assume steady state. Yep, so definitely.
But you have the capability.
We have the capability of altering that. Yeah. What if there was a huge recession? What would happen?
Other questions?
Hi, Lynn.
Hi.
I was wondering, and this is a little off the edge, but it relates to our previous speaker in terms of looking at, I was surprised at the number of people who did not use the long-term care benefit part of Medicaid. And I was wondering if you or anyone has looked at healthcare costs or healthcare outcomes between those people who use the home and community-based services particularly and those who don't use them. And if you look at it in terms of how that might figure into some of the managed care types of options of products and including it in health insurance of there being a benefit to, particularly I'm concerned about the benefit to beneficiaries in terms of improved outcomes and health outcomes.
Right.
But that obviously has cost implications as well.
Yeah, we didn't look at the acute care part at all, but we certainly could, especially around, we could sort of try to do a comparison of people that looked alike who don't use and use. That'd be super interesting. And whether it has what kind of impact it does have, both on their use of long-term care. It's a really good point. I was going to say, did you listen? Did you hear that? Yeah, it's really good.
Any other questions? Going.
Gone.
Well, and we are particularly proud, as you should be, that we're the only state that has this kind of state level simulation or projection model to help us with our policy analysis. So we thank you for all of that and for all your good work with your team.
Yeah, thank you. Thank you.
And now, moving right along, John O'Leary will talk to us about the life stage product that was mentioned or referenced in Vince's talk, but he will give us more information on what that means and the pros and the cons and all kinds of good things. John?
So I'm here to talk about life stage, and this is one of two products that we're going to talk about today, but I just wanted to, Lorraine in her earlier comments had actually made a statement, and she said there were a number of different product proposals that we looked at way back when on the Own Your Future work that we've been doing. And she had mentioned 15, and this was a chart that we actually had way back then. And you can see that we've circled the one over here, further development of a combination term insurance and long-term care for lifetime protection. That's this life state. And also the study feasibility of a LTC product in Medigap or Medicare Advantage plans. But there are a lot of other things that were on that list as well that I think are worthwhile just mentioning, especially in light of some of the things that Vince had talked about in terms of areas that we might be interested in. So, and these are areas that in the future, we are interested in moving forward. But some of the things there, we talked about the idea of a transition product, a marketing startup product of some kind. We talked about the someplace on here is catastrophic. Exactly. There's a catastrophic plan that we talked about as far back as 2015. So we've really been thinking about that. The difference of that, we also looked at some HSA type plans and 401k and how do we do a better job on that, which of course was a great part of what Vince talked about today. So my only point is that the Own Your Future initiative, these are the two products that we started off with. It was determined that these were the ones that were potentially the most feasible and would have the best impact on a shorter term basis. But it's by no means all of what we are interested in and want to look at on a going forward basis. So I thought Vince's presentation today was just excellent in that regard. But I just wanted to bring that up. When we started taking a look at this, and these 5 pillars actually apply both to the life stage product and also to the Medicare product to various degrees. But we had sort of 5 principles that we wanted to work towards. Actuarial soundness was one of them. And in the case of life stage, and I guess in the case of Medicare as well, we used United Health Actuarial Services. In the case of life stage, Clark Heitkamp. Clark's a great actuary. He does a lot of work for the CalPERS program in California. So he helped us develop some of the pricing assessments and whatnot. And we have a report, a full-blown final report that'll be ready in about 2 weeks. And as part of that, there's a great actuarial appendix that has all of his assumptions in there and all of the work that he did. And there's 7 or 8 different sub exhibits there. So really feel like we did a good solid job in terms of at least putting out the idea of the feasibility from an actuarial standpoint of life stage and also of the Medicare product. One of the things that I'm a consumer marketing. O'Leary Marketing Associates would suggest that, and that's actually true. I'm very interested in getting consumer feedback, and one of the key things that I wanted to do was just to get consumer feedback on life stage. And we actually were very, so we started off with the idea, well, what could we do that wouldn't be too expensive? And we developed a focus groups, a set of Minnesota-specific focus groups on life stage. But then we also had a very interesting situation that occurred. And that is that we were actually able to get into a project that was being sponsored by the Society of Actuaries. Vince had mentioned that he and I are co-chairs of the think tank, the Society of Actuaries think tank. And the Society of Actuaries actually was looking for 2 projects products to look at, to evaluate, and coming out of think tank experience. And Life Stage was chosen as one of those products. So in addition to the qualitative work we did here in Minnesota, we also did a major quantitative study with them. And I want to, in addition to the great work we've done here and great work in Minnesota, I want to thank the Society of Actuaries for the work that they did in terms of helping us round out the consumer research project. And I'll talk more about the impacts of that as well. Lynn talked a little bit about the impact on life stage with the SHADE Act model, and unfortunately, as she said, because that model only went to 2030, and really, from a life stage perspective, the way the product works, as I'll explain in a minute, if you really you end up if your target audience is a 40-year-old, that product wouldn't affect the long-term care part of that product wouldn't go into effect until age 65. And so that's a 25-year time frame before the long-term care piece of it kicks in. And her model just doesn't go out that far. But the good news is that as part of that Society of Actuaries project, there were 2 other parts besides the consumer research. One was a marketing projection, where they actually gave a 5-year projection in terms of what the volume in dollars and units would be. So I'll explain that in a second. But the other thing that they did was they did a model, and it was actually done by Brian Eulery of the Long-Term Care Group, and that model actually projects out 50 years. And so we can actually see some of the impact, not on a state basis, but on a national basis of what that model had. So we've got, so the first 3 here, the actuarial soundness, the consumer interest, and the economic impact, I think we've done a really good job, developing feasibility studies for that, and I'm feeling very, very comfortable about that. Regulatory acceptance and operational approach are 2 other parts of this that need work. And on the regulatory side, part of the problem that we have is that, and again, when I describe the product, you'll get to see that a little bit more. But the type of product that Life Stage wasn't really contemplated in the Long-Term Care Model Act. Now, it doesn't mean that we can't do it. We've had a very great relationship with the Commerce Department. Fred Anderson's over here. He's been extremely supportive, not just of life stage, but of innovation and long-term care in general. And they've been wonderful to work with. So we have a good relationship there, and trying to work on some ways that we can overcome any of the regulatory hurdles that might be there. The other issue is the operational approach. I mean, how would it actually work, and who would actually be the insurer? In our view, the insurer will not be the state. We're not looking to make this a state product. What we're looking to do is to provide information, help, and encouragement to private long-term care insurance providers or other providers who might be interested in being carriers on this. And so, so I'll talk a little bit more about that as well. So let me just talk a little bit. I'm going to skip over this slide because Vince did such a great job talking about the traditional long-term care market and where it's been. And really basically he covered all that in much more detail than I have. I just talked a little bit about, and I'm kind of going to skip this one out as well, about the studies that we have, the actuarial analyses, the 2 consumer testing pieces that we have, and the financial modeling. So let me tell you what the product is like for those of you who don't know, and for those of you who do or have heard of it before, a little bit of a refresher. The idea of this is that Life Stage actually is a life insurance, provides a life insurance benefit during working years. And we, for argument's sake, have said up till age 65, although that age could be different. It could be 68 or 70, but up to a fixed age, you get life insurance to protect you while you're working. And then for the same premium and the same level of benefit, that product transforms into a long-term care insurance product when you hit that transition age. So life insurance during working years, long-term care insurance when you need it most in retirement. A lot of times in Vince's presentation, he talked about simplicity and clarity. One of the things that makes a long-term care insurance product complex is a wide number of options, a lot of choices that you have to make, and maybe consumers not really being knowledgeable about how to make those choices. Here, the choices are simple. When you buy the life insurance product, if you buy it at $100,000, $200,000, or $300,000, and those are the 3 options, benefit options that we've talked about, if you buy one of those, and you pay a certain amount per month, you'll continue to pay that same amount per month when it turns into long-term care, and that's the long-term care benefit that you'll get. The other thing that Vince talked a little bit about was the idea that a lot of folks, only about 15% of folks are really going to need a long duration benefit. And our idea here was, and I think Lorraine captures this idea very well with the Minnesota phrase, half a loaf is better than no loaf at all. And so essentially, in our thinking about this, our thinking was some protection is better than no protection at all. And so what we're not, saying that we're going to do is cover that catastrophic situation. We can certainly contribute to that, but that's not what the goal is. The goal is here to have an affordable plan that people who can have some help in terms of the long-term care piece of it. And the simplicity aspect is really simple, because once you make the decision on which one of those 3 benefit levels you want at that premium, you don't have to make another decision. Well, you actually do. Because the other thing that we've done is that you'll recall that Vince mentioned that the built-in inflation option was something that, from a point of view of the industry, has really not worked very well. And certainly the 5% built-in inflation option hasn't. So when we've done our pricing on here, we priced it so that we would have a future purchase option of some kind. In other words, people could buy more coverage over time if they wanted it. And in terms of the discussions I've had with Clark, he said, and they wouldn't need to necessarily be underwritten. That first underwriting that they have early on in the process for the life insurance policy would carry through. So pretty simple, pretty easy consumer decisions. And as a consumer marketing, I mean, that's kind of what I like. So let me, the other piece of it is that there are a lot of different operational ways this could work. Currently, my thinking on it is, but this is by no means what an insurance carrier would need to do or whatnot, is that it would be a life insurance product with a conversion rider. Today, life insurance products, term life insurance products, have conversion riders those products convert to whole life or universal life. But if you read the verbiage around it, it doesn't say that it has to be life insurance. And the idea here is that the term insurance would have a conversion rider, which would enable you to convert to long-term care. And we would probably specify the age, because it turns out people have a hard time trying to decide, well, do I need it at 65, or do I need it at 67, or what if I get it at 70 and I don't need it till whatever? I mean, they just seem to have a hard time with that decision, so we'll probably simplify that. But that's our thinking right now in terms of the operational aspect of things. Target audience. Our original target was 50,000 Minnesotans with middle income, which we defined as 50 to 125,000 a year. And our target age originally was actually 40 to 55. What we found out in the research is that target age was probably too old as a starting point, and so we've changed it down to 35, and it may even be lower than that, because it turns out that if you wait too long to start marketing this to them, they've already got term insurance, and so marketing to them at a younger age, makes that a more likely sale. Let's put it that way. And in terms of the national program, the SOA program, they actually did do they did the research on 50 to 500,000, and you notice that was what Lynn had in hers. We're still, for the purposes of this in Minnesota, we still want to focus on the 50 to 125,000. But that's the target. That doesn't mean you can't sell it to people who have a slightly higher income or slightly lower age. So to give it an idea in terms of the target audience and how that would work. From a distribution standpoint, this is one of those things, and again, going back to Vince's presentation, he talked a lot about worksite and the employer group market. And really, right now, there's a dearth of products that are being sold at the worksite. It turns out when we asked them, both in the focus groups here in Minnesota and in the national study, they really valued, what they wanted to do was they wanted to buy this from an employer or be able to buy it direct. And because it's designed to be simple, this is the type of thing that can work well on a direct basis and doesn't necessarily need a broker or an insurance agent. Sorry, Tom. However, there is an educational role in all of this. This is my too busy slide. It's got clearly too many numbers on here. But I just want to point out a few of them. So if you look at the $100,000 line, you can see for ages 35, 40, the pricing is below $50 a month for this product. Even when you go up to $150,000, the pricing is still pretty reasonable, below $75 a month, and that's for the males. Females, 35 years old, for $100,000, they can get a $100,000 policy for a little less than $40 a month, and a $150,000 for just a tad more than $50 a month. And that product would provide them with term insurance from the time that they buy it in their working years, and then convert to long-term care later on. And so what you can see is that from a pricing standpoint, there are some pretty favorable price points here. And again, this was done by Clark and UHAS. A company, a carrier who went out, might have different assumptions. They may or may not be able to achieve this kind of pricing, but from an affordability standpoint, at least based on this feasibility analysis that was done, it looks like these products are pretty affordable compared to other things that are in the marketplace. How much more would it cost to buy a life stage product versus buying a similar life insurance product? And there are a couple just ages here to give you a sense. And so a 40-year-old male for $9 more a month could get the life stage versus what he would pay for a similar term life insurance policy. If you look down at the chart below, which is compared to long-term care, a 40-year-old female could get the life insurance aspect for about $8 more a month than she would pay for just a long-term care policy. So you can see that, particularly at the younger ages, there's not that much of a difference. You're not paying that much of a premium for either for the life stage over what you would pay for if you got the either the term life or the long-term care policy. Higher ages, more benefits, yes, it will be more, but it's still not a huge number in terms of the difference between the two. And I'm going to just show you what happened in the national study, the SOA study. And here, what we found is that people said 49%, about half of the people said they were interested in investigating further, and about 21% actually said that they would be interested in buying, this was actually a model, a very sophisticated model at Maddox Douglas, the folks who did this research project for us, buying in the next 2 years. So 21% of the people would be able to buy in the next 2 years. Here are the market projections. This is life stage purchases for 5 years in terms of numbers of people who would buy, and on the right, dollars. And you can see that by the third year here, 119,000. If you look back on Vince's charts, and I'm not sure if he had dollars, I think, but if you look back on his dollar charts, and the one on the right, that 115,000 in terms of 115 million is more than what the total existing long-term care traditional dollar sales are. So by the end of the fifth year, we'll have about 320,000 products sold, and it will have about a $350 million according to these projections. And so I think the marketing projections, and again, very sophisticated, very battle-tested model used by Maddox Douglas, show the potential for success. I want to show this one, which basically this is if you look, the best place to look on this chart is the first column down here, which says 41.9%. This is the Society of Actuaries modeling projection that I talked to you about that goes out 50 years. And here they're showing that Medicaid expenditures would actually be reduced over the 50-year time frame by over 40%. And you can see if you look above that, that very few of those expenditures are going to be achieved in the first 20 years. It's not until you get to years 21 and 30 that you really start to see the impact, which is why I think it's so important for the folks at SHADE to be able to put that one out. One last slide, Lorraine, and I'll be done. What this slide does, and I'm not going to actually go to this slide because I want to hit the next step slides here for a second. What this slide does, though, is it talks about some of the plan design things about life stage that I call them risk mitigating factors. And again, I spent a little bit of time talking to Clark about them. And it's some of the things that seem to make this a less risky product and one which is less likely to see price increases are things like the limit on the total benefits. It turns out that there's better claims experience on products that have lower benefit levels than ones that have higher. The idea of using the future purchase option versus the no built-in inflation, and the fact that it's going to take a while for the long-term care benefit to take effect. It's almost like a 20-year vesting period, maybe a 25-year vesting period. And then the last piece on that, and there's more to this, but I'll just say the last piece on that, is that from a consumer buying behavior, I think one of the things that we talk a lot about is adverse selection. And Vincent said, we don't know why it is that the people who buy the product seem to need the product more, but they do. And one of the things that if you have a combination product like this, where people are buying it not just for the long-term care benefit, but really more importantly for the life benefit in this case, they have a different consumer purchase behavior scenario. And so that's a key piece of it. They're not just buying it for long-term care, they're buying it for one kind of protection now and another kind of protection later. So our next steps will be in the area of regulatory pathways and carrier exposure. Basically, we're going to continue to talk to carriers, and we're going to continue to work with the Commerce Department and others to try to make sure that that the product concept, as we've designed it, can actually work in the regulatory environment. And that may mean some changes, some legislative changes and regulatory changes. So thank you very much. I appreciate it very much, and I'll be around for questions after.
Thank you. It's a privilege to be here. All this stuff will be up in a couple weeks on the website, by the way, because I'm going to blitz through my stuff, and I'm actually going to change it at the beginning. So Vince had some good points, and also there was a question from the audience that was really good. What about boomers? You know, what do we do now to take care of people's long-term care needs? And if you think about the way Medicare is structured, it's a universal program. Everybody goes into it. You have instantaneous coverage, if you will, covers a wide array of services. And most people don't know that it's becoming something of a default long-term care program. 1988, about 3% of Medicare went to SNF and home health, skilled nursing facility and home health care. Now it's up, like in 2016, it was like 14, 15%, not even counting the money coming in through the Part D drug program to seniors and getting home care or skilled nursing facility care. And then at the end of this presentation, I'll talk about another change that's coming in the Medicare Advantage side. So you've got a program that's delivering long-term care coverage. People would consider it long-term care, not post-acute, which is technically what Medicare is covering when it covers SNF and home health. So you've got a program that does all this stuff. So one of the reasons I think Minnesota went in the direction of including Medicare was it would be something that would cover people right away. And for the first time, Minnesota's gone over 1 million people in Medicare. You can see the split between MA and Medigap. Minnesota is something of an outlier state. The Medigap percentage is about 13%. In the rest of the country, far more people are in Medigap than they are in Medicare Advantage plans. The SIM is a state innovation model grant. So this was the funding source that helped us do work on the two products, Life Stage and the Medicare one. We had an actuarial analysis, the consumer testing, which was mentioned. The third thing is the stuff that SHADAC was working on. The fourth point, actually, people like John and I are hired to do this stuff, but we did a lot of outreach to folks that were like the health plans, council of health plans were really a good source of information and dialogue. We did talk, Steve Schoenfeld asked about the Medigap carriers. We've talked to some of the people in the Medigap side, but part of the reason we haven't gone further is we needed all this research to be done, and to some extent we're taking a pause to see where we're going, and again, that feeds into something at the end that's going on with the Medicare Advantage plans. So what we're talking about with this particular benefit structure is a non-medical home care benefit that would be provided to all the supplemental plans in the state. So you've got the Medicare Advantage and a variant called cost plans, and you've got the Medicare supplement side. That together covers about 85% of people that are on Medicare in the state. Other people have employer coverage, or they just have traditional Medicare with no supplemental coverage. So what we wanted to do was an intervention that, and I'm going to use the ADL concepts because it's important as we go forward with some of these things. So the inability to do an activity of daily living like bathing, dressing, toileting, transferring. In the long-term care insurance world, it's a 2 ADL trigger. We were looking at something that was sort of like more like a 1 ADL situation. The person needs something to stay at home, but it's not dramatic. Later on, we'll be talking about a piece of legislation at the federal level called the Chronic Act. That goes for people with complex medical conditions. That's like a 3 ADL kind of stuff. So you've got different interventions you could do across time or conceptually how you would want to address different populations. And as I said, the Minnesota idea was to try to reach out to people before they got further along in the continuum of disability. So the model we used was something that's comes out of the Medicaid side, this Essential Community Supports program. It's an existing program. They've got a set of 8 services coming through the Medicaid side. You do have limitations, including means testing. So we developed this package. The right-hand side are the different actual package elements for the ECS part. Down at the bottom there where it says PCA assistance, that's personal care assistance. That was a sidebar kind of modeling we wanted to do. That was more along the lines of what you would see in a scaled down long-term care insurance approach. So we wanted to see what that would be like but test that separate. So we ran the actuarial stuff both with and without this personal care assistance. And that, and I won't go into it for lack of time, but basically that's kind of stuff we're talking about with the quasi long-term care insurance approach. The benefit triggers, even though I talked about it as like a 180L kind of stuff, this is coming through the Medicare program. So we're following the Medicare rules. And that's particularly important for the plans. A lot of our conversations with the plans, they don't want some new long-term care eligibility kind of trigger for people. They want to keep it with Medicare. So whatever the trigger mechanism is for Medicare is the trigger mechanism for this add-on services. In the second bullet, no means testing, no age limits. Again, we're tracking Medicare and including everybody in that. Services are authorized when Medicare would otherwise approve home-based medical care or therapies. So this one is the numbers. So we have separate actuarial calculations for Medigap versus the MA and the MA cost. And then, as I mentioned, we did it with and without the PCA. For a variety of reasons, I think we're probably moving forward more without the PCA. So the one that talks about the without PCA numbers are probably more relevant. So this is monthly premium increase. Now, we're embedding this product in all supplemental products sold. So you don't have a choice, an adverse selection situation where somebody says, I don't think I'm ever going to need it, and I don't want to buy it. The people that do see the need would end up buying it. And we know from long-term care insurance, you don't want that kind of adverse selection choices. So this is embedded in there. So everybody's going to see with Medigap, if they have a Medigap plan, they're going to see an $8.50 more a month premium, and it will be in their total premium package, so they don't actually see it as a separate number. Same thing with MA, that would be the increase is a little bit short of $7 a month. But that doesn't mean the MA plans would have to increase it that way. They could find that the savings by doing these interventions would allow them to keep the premiums down. We had special consideration of the people under 65, didn't find much dollar difference by including them, which was an interesting finding, but we certainly didn't want to exclude people with disabilities. We tested different models like elimination periods and cost sharing and all this kind of stuff. Some stuff you didn't really want to do. You didn't want to tell somebody that they would have an access issue to get the very benefit you're trying to get to them so that they can stay at home. So we sort of backed away from some of that, but there are options if we go forward and somehow we have to reduce the price a little bit more. The focus groups, people loved it when they had it explained to them. And it was funny, they didn't really have a problem with either dollar amount, but I think, as I say, going forward, the addition of the personal care assistance thing seemed to be a price point issue when you actually talked with the carriers and the people who would actually have to try to do all this stuff. So, but it was nice. It was nice to have real people saying that they appreciated this kind of stuff. And again, I won't go through it, but they liked having a support system that would come in and help them out. So a couple slides on that. I really won't get into the SHADE Act stuff because Lynn covered that, but there's out of one of their reports, $376 million in savings over the 15 years versus what Medicaid would have spent or will spend on these kinds of services. So our intervention of adding these kinds of services to Medicare will help Minnesota Medicaid program to the tune of almost a third or over a third of $1 billion over that 15-year period. So, new developments. So we're tootling along and we're thinking we're going to add this stuff and we're talking to plans about it. And all of a sudden, I should back up. So we have a conversation with CMS a year and a half ago, and they loved our idea, but they said, well, there's no legal authority to do it. So then February of this year, they come out with this suggestion that maybe they allow the MA plans to add non-medical services. And in their call letter in April, they told MA plans, go add this stuff. You're free to come forward with stuff. So they have negotiations and all that stuff with the plans, and I'll get into that. Almost the same time in February, the Chronic Act passes. And one of the interesting things, I know there's always this talk about deadlock in Washington, 98 to nothing out of the Senate. Yeah, so you can get bipartisan stuff through in our topic area. Everybody loved the fact that you would be able to address people with chronic illness in a way that would allow plans to deliver care to them. So the call letter for the change in CMS authority was effective for the 2019 plan year, the one that's starting next month. Chronic is 2020. So, as I say, it comes out in the call letter in April, and the plans are like, whoa, what do we do? So it turns out not too many of them did it. I think it was like 10% of the plans did stuff, covering like 1.5 million people. That's nationwide. And 1.5 million people, and this is total MA population is about 20 million nationwide. The plans were admitting that they were just, do some pilots, see what they might be able to do. Avalier Health, this last bullet, did an analysis of what were the most popular things that the plans were doing: caregiver support, in-home services, the social worker thing, adult daycare. Some of the things they're doing, also non-emergency transportation and meals were two other things. The stuff they're doing is sometimes the same thing we're doing or talking about doing in our basket of 8 benefits, but some things aren't. So they're going away from where we're going, which again gives us pause. We don't want to get in the way of the MA plans. They're going to be doing stuff like this, and they presumably have a better handle on what interventions are best, like meals or non-emergency transportation, that would help the most people and save the most money. So basically, we're at this point where we're, as I say, taking a pause and trying to figure out what we would want, where we would go with that. The plans for 2020, the health plans for 2020, will presumably be much more active. They'll also have the chronic component to offer. So our expectation is that in 2020, there'll be a much richer and broader array of benefits being offered by the plans. So I think we want to see where that's going. And we don't have to wait to 2020 to get that, because we'll see the plan filings in the spring and the summer, and the approval by CMS in the late summer into fall. So sometime before this time next year, we'd actually be able to see if the plans are doing things. And that's on a nationwide basis. We also have to see what's going on in Minnesota. Before we go forward, I will also point out, going back to the Medigap market, this is MA only. Both chronic and the CMS change are MA only. Now, in Minnesota, that works out for us because it's, as I say, 13% of people are in Medigap. But our proposal, our approach would have taken the Medigap side into consideration as well. So maybe we do something like let the MA plans go and concentrate on Medigap. This state is what's considered a waiver state, not like a Medicaid waiver, but a separate waiver under the Medicare supplement laws. So Minnesota has more control over their Medicare supplement design than most states. So we could do something on the Medigap side too. We don't want to be out of sync with the markets. We don't want to be telling the MA plans to do this or that, and the Medigap guys doing something different. So again, we're taking that pause, I guess, in the action, and we'll go back and reassess and see who we have to talk to and where we want to go. So.
All right, thank you, John.
Questions?
Thanks. This is for John C. Not John L.
John C.
John C. John, do Med Advantage plans, if they start to offer home health care benefits, are they required to continue to offer them in perpetuity, or are they allowed to narrow them? I used to work on a Medicare Choice Plus plan 20 years ago, and we were trying to put gyms together and other kind of benefits together at that time, and I don't recall.
Right now, yeah, that is actually one of the considerations. Larry Atkins of the Long-Term Quality Alliance, LTQA, just did a really nice report funded by the SCAN Foundation. And one of the things in talking to the plans, was a concern if we put forward a certain benefit, what do we do the next year if we decide we don't like that benefit or it doesn't work? It's not even a pricing thing, it's whether you just completely drop it and you've got beneficiaries that are relying on that. So that is a concern that exists with an add-on kind of benefit like this. It's not a concern with something like flu shots or something that is in the Medicare program, and Medicare is unlikely to suddenly say, you can't do flu shots or whatever. So it is a concern, and we'll have to see where the plans go with that.
So is there some legislation to require that? Like, my mom loves silver sneakers, but I guarantee she's not expecting to have that at 95.
Yeah, no, well, I don't think the state wants to go in and make people do silver sneakers if they're not going to do.
I'm just curious whether any of the Minnesota MA plans participated in the first round of the 2019 call letter response.
Well, that's a good question. We are reaching out to the plans to find out. Any health plans want to volunteer and
I
answer?
know it's a hard process to find out.
Yeah, I know, and I don't think any are, but I'm not 100% sure.
We are having a session on that at the Long-Term Care Insurance Conference, and we're also having a session on supporting family caregivers. So,
huge issue.
Any other questions or comments? It'll be interesting to see how our Medicare environment evolves, particularly given the cost plan issues that we're dealing with as a state and sort of our uniqueness. Well, thank you all for being here today, and I hope you all had learned as much as I did. And thank you, Lorraine, and to DHS staff for putting this on, and also thank you to the Commerce Department and Revenue and MMB and all of you that are partners in the community for your continued work and innovation in this space. It's so important, something that we're all going to have to deal with at some point if we aren't already. So thank you for being here, and have a good day.
Thank you, Commissioner.